We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome in to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott. Hey, you can always go to Brian's website. There's a lot of great information there. You can find out about Brian and the team, the offices that are in Washington, California, and Utah. A lot of things, a lot of advisors. We have them on from time to time, but today, Brian J. Decker is going solo. He's going to carry the entire show. Should be entertaining, but a lot of great information as well. DeckerRetirementPlanning.com to find out more. Plus, don't forget, I tell you every week on the show that under the heading on the DeckerRetirementPlanning.com website, under the heading of Safer Retirement Education, there are about 12 different things you can download. No cost to you, no obligation, no pressure, nothing. It's there for your information. Brian's book on retirement, The Decker Approach. 3 Principles of Retirement book, the Checklist Challenge, Sample Income Plan. Those are just 4 of the 12 things you can download right there under the heading of Safer Retirement Education on the website, DeckerRetirementPlanning.com. And of course, you have questions, you want to talk with somebody on the team. Hey, I'm not really sure what I should be doing. I'm a little confused, the markets and so forth, the Fed. And we're going to talk about the Fed today, but it's 833-707-3030. No cost to chat with the team. They're here to help if they can. They just don't know if they can help you until you reach out. 833-707-3030. So we're going to talk about the Federal Reserve and some of the moves that they've been making. And really, they're raising the interest rates to fight inflation. Now, Brian, last year in 2022, in March, they started with a 0.25% bump of interest rates. Then June, July, September, and November, it was 0.75%. Then December of 22, it was 0.5%. Well, they've started January in 2023 with a 0.5% raise to the interest level. And then in February, it was just 0.25%. What's the deal? Is the Fed, remember, they were kind of late to the game a little bit when they said, this is transitory. It's going to be here and be gone. And then they've had to kind of play some catch up, right?
Right. They've raised rates pretty quickly. Back when the Fed was raising rates, back in the late 70s, early 80s, the Fed rate hikes were pretty small compared to the steep increases that we've had in such a short period. So hats off to Chairman Powell to raise the rates very quickly. But it's interesting, Mark, why it affects retirement and retirement portfolios and the stock market. Mark, if you have really low interest rates where your 10-year CD is yielding 1%, a lot of investors are going to take their chances by going after dividends in the markets. Low rates brings them into the markets because they want dividends, or they want to take their chances for a higher return than a 10-year treasury or a CD rate at 1%. When rates go higher, more and more people come out of the market because, like right now, the 10-year treasury is at 3.5%, and some of the CD rates and MYGA rates are at 4 and 5% for 3 and 5 year rates. And so people are saying, hey, I'll just put more money, especially after last year where the S&P was down 19%. They'll say, I'm going to just lock up some money, and this is a good rate. 4.5% is a good rate. So money, when interest rates are going up, money is coming out of the markets, and the markets typically go down. And the opposite is true. So when it comes to interest rates and the stock market, that's one of the 3 reasons. One of the 3 things that affects the market. Markets go up. This is easy. Markets go up for 3 reasons. One is declining interest rates. The second is an accommodative Federal Reserve, meaning they're lowering rates. And the third is higher corporate profits. Well, this time now, instead of having those 3 as tailwinds, Mark, now we have those 3 as headwinds. Corporate profits are expected to slow down this year around the world. So you're seeing that in some of the layoffs that are happening, especially with the technology sector. I know Dell just announced before we went on that they're laying off 5% of their worldwide employees, and they're a big company. But layoffs are happening. The economic slowdown is happening, and the Fed wants to slow the economy down to bring so that they can slow inflation down. And they were on track. The 25 basis points was a good thing, and the markets went up after Chairman Powell mentioned that he might raise rates one more time and then hold them steady for the rest of the year. 25 basis points, Mark. It wasn't long ago when the anticipation was that the Fed rate hike in February was going to be closer to 50 or 75 basis points. So the expectation is that rates are slowing, rate hikes are going to be slowing down, and then they'll hold steady, which is good news for the market. Until Friday. Friday, the jobs numbers came out, expectation of gains, 178,000 in new jobs, and we came in over 500,000. And the markets went down pretty hard because they realized that the Fed and all it's done is doing its job in all areas except for the jobs market. The jobs market is still holding very firm. And that's something that the Fed has to slow down and hasn't yet, even with all the rate hikes.
So, Brian, you pointed out that the Fed raised the interest rates 0.5% in January and in February only 0.25%, and they're talking about maybe another 0.25% move again in March, and then that might be it for the year. So that's got to excite the markets a little bit, I would think. How does that really affect us, though, heading into retirement or already retired?
Well, the expectation is that the rates would have been only going up 0.25%, but with that huge job number, Mark, now we're talking about 50 basis points, even 75 basis points on the table now. Higher rates hurts bonds. And here's how it affects retirees. Bond funds lose money when interest rates go up. So from 1940 to 1980, that 40-year period, the 10-year Treasury went from 2% in 1940 to 15% in 1980. 40 years of rising rates. Then from 1980 to 2020, nice, neat, and tidy 40-year decline in rates until August of 2020 at 0.47. Well, now the 10-year Treasury has been as high as 4.1%. And people in their bond funds, when interest rates go up, bond prices go down. The average bond fund in the last 2 years is down over 30%. 20% alone for just last year. And so, Mark, retirees should be very careful about bond funds. Bond funds used to be thought of for 4 decades as safe money. That can't be the case anymore. So that's one of the changes when it comes to the interest rates and what the Fed is doing right now.
So how does that affect then the markets? And I mean, because you said that the markets do react to what the Fed is doing.
Yes, markets do react to what the Fed is doing, and it's all based on the effect it has on the bond market and also the present value of the earnings. Higher interest rates means a higher present value for the earnings, for corporate earnings for future, and markets look ahead. So markets went down last year in anticipation of a recession that hasn't even happened yet. Think about that for a second. And why do we know or highly expect that the markets are going to go into recession? Because the rate curve, the yield curve is inverted, meaning that the 3-month yield is higher than the 5 and the 10-year. And so with short-term rates being higher than the 5 and the 10, that's called an inverted yield curve. And the yield curve is more inverted than it's been for over 30 years. And so the expectation is very high that we have a recession worldwide. Now, a lot of firms are chiming in on the research side saying the expectation is that it's not going to be a big, deep recession, just negative GDP. By the way, the definition of a recession is 2 back-to-back negative GDP numbers. We had that last year. The White House didn't like it. They wanted to change the definition of recession. It is what it is. So the expectation is that we go into recession either late this year or early next year. That's what the bond market is telling us, the inverted yield curve.
So, I mean, if we go into a recession, then that's got all kinds of repercussions, I would think. I don't know. What should we be doing?
Right. And so when it comes to safe money investments in a recession with rising interest rates, you can't look at where you can't go. You can't go into bond funds because bond funds lose money as rates go higher. And the expectation is that this year's stock market is that we probably have flat to lower returns. Not only, the Fed feeds into this short term. There's a bigger issue. So I'll talk about both short and long term.
Yeah, talk short. January was pretty good, really, wasn't it? I mean, it was a little comeback, I guess, for the markets.
Yeah, we came probably too far too quick. There's a saying, there's many sayings in the stock market, as January goes, so goes the year. So hopefully that's true. We'll see. But if the whole year goes like January, NASDAQ was up 11%, S&P was up 6.5%, Dow was up 5%. So you multiply that by 12 to get an annualized return, and it's very good. So the expectation, according to that, is that this year will be a good year. We'll see. Short term, markets may have digested already an expectation for a worldwide shallow recession of minus 1 or 2% GDP. So how this affects the retirees' portfolio is we hope that you shy away from bond funds, because in a rising interest rate environment, bond funds have interest rate risk, and interest rate risk is where you lose money, principal, as interest rates go higher. So we hope that at least we at Decker Retirement Planning, we don't use bond funds for safe money investments. We use laddered, staggered, principal guaranteed accounts. So imagine, Mark, bucket 1, 2, 3, 4, and 5. Bucket 1 is a cash account, pays income to our clients for the first 3 or 4 years. Bucket 2 and 3 are laddered principal guaranteed accounts that are fixed rates. So right now we're getting very good rates from MYGAs. Those are giving us higher rates than CDs right now. Those are like CDs from an insurance company, where we're a math-based firm and we take our fiduciary responsibility seriously. So every month we go to the Wink database, look for the highest earning principal guaranteed accounts, and we're finding those in buckets 2 and 3 on a 3 and 5 year MYGA that are much better than CD rates. We're getting over 5% for those.
So we're going to come back. We're going to continue this conversation with Brian J. Decker of Decker Retirement Planning about the Fed and how they're fighting inflation, how that affects us, especially if we're, in retirement or getting real close to retirement. How do we adjust? That's certainly what we're talking about today on the program. If you have questions like that, just concerns yourself about where you are on that road to retirement, you can always call the team at Decker Retirement. 833-707-3030 is the number, 833-707-3030. Back with more of Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning right after this. Stay with us.
Just as the seasons come and go, so too do the markets ebb and flow. If market volatility is making you nervous, give Brian a call and make sure you're not taking on more risk than you're comfortable with. 833-707-3030. That's 833-707-3030. Decker Retirement Planning has a question for you. Is your retirement inflation-proofed? Here's what we mean. In retirement, chances are you're on a fixed income with variable expenses. So how do you not run out of money when the cost of just about everything continues to go up? You inflation-proof it. Brian Decker and the team at Decker Retirement Planning can show you strategies to help combat inflation so it doesn't outpace your retirement income. Call Brian Decker today at 833-707-3030 to learn more. Inflation could take a huge chunk out of your retirement savings, but it doesn't have to. With some simple planning, inflation can go from being a major disruption to a minor annoyance. Call Brian and the team at Decker Retirement Planning now to start inflation-proofing your retirement today at 833-707-3030. 833-707-3030. Investing involves risk. Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. You can always go to the website. You can get those downloadable items, including Brian's book on retirement, the Decker Approach book, DeckerRetirementPlanning.com. That's under the Safer Retirement Education part. There are a lot of different things you can download. DeckerRetirementPlanning.com, though, to find out more about Brian and the team. You can certainly do that. But it's a great opportunity for you to find out more. So you can get Brian's book on the Decker Approach to retirement. A great opportunity for you, no question about it. We're talking about the Fed and how they're battling inflation, and how that kind of has some repercussions. Certainly, we saw it last year. The markets were the worst they'd been for quite some time. It was the seventh worst stock market, but it was also the worst ever by double digits in the bond market last year. And one of the things you said is, hey, bond funds are not good. When the Fed is raising interest rates, bonds work opposite of the interest rate. So interest rates go up, bonds go down. Interest rates come down, bonds go up. So we're in that kind of frame where you think about everybody's 401k, you're getting ready to retire closer and closer. The idea in those target date funds is slide more in those target date funds, Brian, is to move people more into the bond side of things the closer they get to retirement. That is not really what we should be doing at this point, is it?
No, bonds are going to be strike one and two. Strike one is when interest rates go up. Like you said, bond prices go down. In a rising interest rate environment, you don't want to own bonds. Second is, even if rates level out here, we're getting much higher rates than bond funds in the fixed income side. So CDs, treasuries, corporates, agencies, municipals are giving much higher rates than where the bond funds are coming in at. And so when it comes to, quote, safe money, laddered principal guaranteed accounts is mathematically what's giving us the best rate and the less risk, because we don't have any interest rate risk when it comes to fixed rate investments.
So when you're thinking about those moving parts for bonds and all of that, I mean, there's so many moving parts here. I guess because there's some potential problems for retirees with all of this. How should we be looking at it?
Mark, it affects if three big ways it affects the retiree. One, bond funds are no longer safe money sources. So we've talked about that. We hope that clients use the laddered principal guaranteed outline, because if markets go down like they did last year, we're talking about 20% hit in bond funds last year. Our clients didn't lose a dime on their laddered principal guaranteed accounts, buckets 1, 2, 3, 4, and 5. And the second thing is when interest rates stabilize at a higher level, we're getting higher rates on safe money from fixed rate sources. So retirees need to break out of this 40-year-old, it's always worked kind of plan called the pie chart. That's an accumulation strategy, by the way, where all your money is at risk and your safe money is supposed to be in bond funds. That's no longer safe when interest rates start going up. But the second way, Mark, in a huge way that affects retirement portfolios is on the stock side. So we've talked about how stocks in the short term have already priced in a worldwide recession. That's why S&P was down 19% last year and the NASDAQ was down 33%. So what kind of downside protection do you have with stocks, and what kind of exposure do you have to the stock market? I want to stop here. This is a huge point, because in retirement investing, the strategies are different than accumulation strategies in your 20s, 30s, 40s, and 50s, where you're building your retirement. When you're building your retirement, Mark, and the S&P, let's say you're 25 years old, S&P drops 50%. It doesn't matter, because your income's coming from your work. And every 2 weeks, you kick in money into your 401k. So as the markets go down 50%, it takes a year and a half to go down. It takes 3 years to recover. You're better off, because in all of that period, you've dollar cost averaged into the stock market, and you're better off when it recovers.
Because you're buying more, right? You're buying more at that point.
You're buying more at lower prices.
Right.
So when you're retired, let's say you're 60 plus, 65 years old, markets go down 40, 50%. Now that's a game changer, because now you're pulling money from that account. mathematically and factually, if you pull money from a fluctuating account, you compromise gains when markets go up, you accentuate losses when markets go down. And we have a saying, Mark, that it works until it doesn't. Well, markets fluctuate and usually cycle every 7 or 8 years. Every 7 or 8 years, the markets cycle. 2008, 7 years before that, 2001, middle of a 50% market decline. 7 years before that was 1994. Iraq had invaded Kuwait and the market struggled. 7 years before that was 1987, Black Monday, October 19th, 20% drop in a day, 30% peak to trough. 7 years before that was 1980, 80 to 82 was a 45% market drop. 7 years before that was 73, 74 bear market, 40+% market drop. 7 years before that was 1966, 67 bear market. That was a 40% market drop. And so it keeps going. After 2008, there was a single reason that we didn't take that hit 7 years later. It's called quantitative easing. It's a Keynesian market stimulus that's supposed to be short term, and we kept that long term. And then we added modern monetary theory, which is printing of money. No wonder we had inflation. And then on top of all that, we had over 5 trillion in market stimulus during and after COVID. And so with all of that, we had a 19% S&P market drop. But here's a long-winded way in saying things have changed. With all of that stimulus, the S&P got up to over 30 times earnings. And that's only happened 3 other times before November of 2021. 1929, the great market crash, markets were valued over 30 times trailing earnings. And it took 17 years to get your money back. 1964 was 18 years to get your money back. November of 1999, it took 14 years to get your money back. And now, Mark, November of 2021, we were at 32 times trailing earnings. And now the expectation is, if history repeats, and we believe it will, that we are looking at 10 plus years of flat, choppy markets where you don't make anything in your portfolio in over 10 years. If history does repeat, then buying and holding the passive investment strategies that have worked for decades will no longer work, because those buying and holding mutual funds or stocks or indexes, ETFs, those will go up and they'll go right back down, go up and down for 10 years and not go anywhere. Imagine, Mark, how devastating it is for retirees to pull money out of an account that hasn't grown in 10 years. And add on top of that, we have inflation. So it's a double whammy. And so the retiree needs to have an active portfolio management strategy if they're going to make money in up or down markets. So what we've done the research already, Mark. Every quarter, we go to the databases, look at the Morningstar database, largest database of mutual funds in the world, the Wilshire database, largest database of money managers in the world, and 2 others. And we have 4 requirements for these managers. 1, the manager has to have gone through a down market like 2008, or they've not been tested. Number 2, the manager has to show actual numbers, no hypothetical, no back-tested numbers. Number 3, the manager has to show numbers net of all fees. And number 4 is the most important. They have to show their portfolio performance with third-party verification. So we gather all the data and we have 4 filters. We get rid of managers that are closed to new investors. They're not taking any new clients. Number 1. Number 2, we get rid of managers that are hedge funds because of their volatility. We get rid of those. Number 3, we get rid of managers that have per account minimums of $3, $4, or $5 million. And number 4, we get rid of managers that are high beta. In the good years, they go way up. In the bad years, they go way down. And Mark, would it surprise you if I told you that the best performing managers in our search, in our due diligence quarterly, for the last 20 plus years, they're all computer algorithms, computer models? Would that surprise you?
So there's no emotion. There's no emotion in that.
Right.
It's
There's
facts.
no fear or greed. that hurts investors. And they're actively managed, meaning that you're invested when markets go up and they take you to cash when markets go down. So you're able to make money in up markets. You're able to protect capital in down markets. We're here to say that we can't, Decker Retirement, we do our homework, we've done our due diligence. We don't know a better way in retirement to grow your money so that you can be on top of inflation, the CPI numbers, but protect your capital when the markets go down. That combination is very important. And that's one of the biggest reasons that people from these radio shows contact our firm.
Yeah, so if you think about it, if you were trying to do this on your own in 2009, well, easy, right? The next 12 years, basically everything was going up in the market. So it was a pretty easy time. But now it becomes so important, especially the closer you are or even in retirement, to now have somebody that's looking and managing your money a little bit more time sensitive rather than just the old buy and hold that Brian was talking about. It's really about the team at Decker Retirement. How can they help you put a plan in place for what's going on in the economy and the markets and all of that in the bond market? Because everything's changing all the time. Brian and the team are there to help your portfolio kind of keep up with what's going on and where you're not getting run over. Hey, I'm pulling money out. The market's down 20%. Now what? I'm losing money even faster. How do I make sure that my money lasts as long as I do? That's what Brian and the team at Decker Retirement are all about. How do they put your portfolio in a better position for the times that we're going through right now? That's really the key. How do they help? Well, they don't know how to help you because you haven't reached out to them. And you don't know if it's a good fit for them or they're a good fit for you until you actually chat with them. That's why we think this phone call is painless, right? You're just calling going, hey, here's some of the questions, concerns I have. Brian, do you think you and your team at Decker Retirement can help? That's how it all starts. And then you go from there. Maybe that'll be your only conversation, or maybe you'll say, hey, we want to come in and go a little deeper. We want to find out more. And how should we position things going forward? How do we make sure that our money will last as long as we need it to? How do we make sure that, if something happens to me or us, that our kids will be okay? How do we make sure of all of that? That is the idea at Decker Retirement, to put all of this in place for you and your family. All you have to do is give them a call. That's where it starts. 833-707-3030. There's no cost for this. There's no pressure. There's no obligation. 833-707-3030. So think about this. I'm 63. I'm going to pose a question to Brian. How in the world will I ever retire if I need my 401k to grow to be able to retire, say at 70, and he's giving me markets are going to do nothing for 10 years. How in the world do I deal with that? Maybe some of you have the same situation. You need your portfolio to grow to be able to retire when you want to. That's where we're going next. And then how did Brian and the team really putting this plan together for us really help us? That's where we're going next. Stay with us. This is Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. Right after this, stay with us.
Excited for retirement? All that daydreaming can be time-consuming enough as it is. So why not get a little help with your retirement planning? Call Brian at 833-707-2020 and see where you stand in retirement.
Welcome back to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. Again, you go to the website to learn more, deckerretirementplanning.com. You can always give them a call. It is 833-707-3030. No cost for this, 833-707-3030. We're talking about the Fed fighting inflation and how that's affected the markets and the bond markets and all of those kind of things and what we should be doing. And you think about it, Brian, you just said you think that the market's way it looks is it's going to be 10 years pretty flat. Well, I'm 63. I was hoping to retire at 68 or 70, hopefully, but I need my 401k to grow. Well, last year it took some shots. So for somebody in my position in a 401k retirement world, what are the options? Because you're not going to, I suppose I can. I'm over 59 and a half. You could actually take my 401k and then manage it more for me, I suppose.
Mark, there's three parts to a retirement portfolio. There's cash, safe money, and risk. And what we do, because we're math-based, we're fiduciaries, we meet with our clients, 6, 7, 8 times, 90 minutes each to put the plan together. We're very thorough. First meeting is a get to know you. We ask questions about your income streams. Do you have rental income? Do you have pension? What's your Social Security? What's your plan for Social Security? We help you with that, by the way. We produce for meeting 2 a Social Security optimization report that's math-based. But we show you in meeting 1 the contrast between the banker-broker model and what we do. The banker broker model is an accumulation strategy. What we do is a distribution strategy. We show you in that first meeting the contrast in strategies. Second meeting, we review your Social Security optimization report, version 1 of your distribution plan. We make changes. We make changes almost at every meeting, where we get together and we tweak this number or that number, but we get the numbers right. And then number 3, we go through what we call a summary of services. Here's the next 4 or 5 meetings, what we're going to cover. We outline those in detail, and we cover fees. Fees are, on average, the retiree in the United States is paying 1%, Mark, 1% on all of their retirement plan. Our clients are not paying a management fee on typically 75% of their plan has no management fee, and we only charge 1.4% for the 5 managers that we use, only for the risk portion of their portfolio. So that works out to be about 0.3 of 1%, 30 basis points on their whole retirement plan. And that means that we're saving our clients typically about 70%. 70%. Meeting 3 is where we go through and hammer the plans with the biggest problems that I've seen in 37 years of doing this. I look and see what the problems are now, and we address them now, not at 10 years from now or 5 years from now. We address them right now in putting your plan together. Meeting 4 is where we talk about all your potential options for cash, safe money, and risk. We cover all the different options. And we talk about advantages and disadvantages. Meeting 5, we put your plan together. Meeting 6 is we go over any Q&A, make sure it's all perfect. And we also look at something called the funding sheet. Funding sheet shows how you were invested and what we would recommend in moving things over to your new plan. So there's tax reasons that we put the Roth money in the risk bucket. We want that money growing tax-free. And then we also want the cash up front, and we put the non-qualified already taxed money up front of your plan so that we can create a window in the first 10 years where, yes, you're pulling income from your plan, but it's already tax money. So the taxes that you owe in the first 10 years are very small. And that creates a window for us to convert IRA to Roth money in your risk bucket. We want the risk bucket money growing tax-free, distributing income back to you tax-free and passing to your beneficiaries tax-free. But this is a long, and then the very end, while you're funding your plan, we also look at your estate documents, your will, power of attorney, living will, and trust. We're not attorneys. We can't give legal advice, but Mark, we are fiduciaries to our clients. And when we see multiple train wrecks at the same place with the same content in these, when you transition an estate with the will, the power of attorney, living will, and trust documents, we owe it to our clients to tell them what the problems are and recommend we get together with their attorney and fix it. So there's multiple problems, and we've covered some of these on other radio shows, but this is the big picture. Mark, there's no way, in our opinion, there's no way you can build a retirement plan in 1 or 2 meetings. Our competitors, meeting 1, how much do you have? Meeting 2, how much can we get and put it in annuities? That is high pressure. There's no way, in our opinion, that you can have a math-based firm, be a fiduciary, and put together a retirement plan in 2 meetings.
So again, if you'd like to learn more, you want to chat with Brian and the team at Decker Retirement, it's 833-707-3030. There is no cost for this, no obligation, but it's a great opportunity. And it's not as Brian said, 1 meeting, hey, here you go, here's the plan. No, it's much more in depth. And Brian, I would think that really when you sit down with somebody, first, before it's ever about money or anything, it's about what are your hopes and dreams, your lifestyle, what are you planning to do, how are you going to spend your time? Because that all factors in, doesn't it? You need to learn about your hopes and dreams, bucket list items of your clients.
Right. And we're being math-based, and so their age makes a difference. Their health makes a difference, longevity, how much money they want. Some people can retire quicker than they thought. Most people, that's the case. some people have to work a little bit longer than they expected, but we figure it out now. Imagine the tragedy, Mark, of retiring and then figuring that you pulled the ripcord too soon and try to go back to the workforce at 70 years old. That's going to be rough.
So you think about that, your process, and it's something, I mean, you've been in this business since 1986 and certainly didn't start your company then, but that's kind of where you all got started, and you got started in this financial world. And your company now has evolved and things are changing all the time. And your company does a tremendous job in staying up with that. Certainly your computer trend market following and all of that kind of stuff. But I would think that it's really important that you do have to stay up with the times. What's going on with the Fed? What's going on in Washington? What's happening on Wall Street? You have to stay up with this because things are changing all the time in the insurance world, the market world. You have to stay up on top of that because your clients need you to do that, right?
Right. Things are changing all the time. And look at we're just talking about the Fed and interest rate risk and the markets and the valuation. We haven't even talked about geopolitical risk. We have a 5-star general that's saying that we go to war in China in 2025. How do you protect your portfolio from that? So there's a lot of risks, and there's 3 layers of protection that we talk about in these meetings with our clients. One is quantitatively, how much exposure should you have to the risk markets when you're retired? Not 60% in our opinion, not 70% in our opinion, more like 25 or 30, where you're getting 20 years for the portfolio to backfill what you're spending in the first 20 years. That's a visual that we see in the distribution plan. The second thing is strategically. So quantitatively, we reduce your risk. Strategically, Mark, we reduce your risk for retirement because when the markets go up and down and flat and chop, if we're using computer trend following models that are designed to make money in up or down markets, we can do well. We can protect capital when markets go down. We can participate in markets that are going higher. And the third and final is we eliminate interest rate risk by not using bond funds, and we're able to put in place into the portfolio things with fixed rates, like cash with a fixed rate, a 3-year and 5-year fixed rate investment. And then we have 7 and 10-year fluctuating rate investments because that's where we're getting the higher rates on the higher amounts of money. So when the markets crash like 2008, buckets 1, 2, 3, 4, and 5 all made money in 2008. 75% of the portfolio made money in 08, and the managers, the 5 managers we use, are able to make money in that kind of a market. That's, Mark, that is what we would recommend for clients to adjust their portfolio, because the investment world changed in August of 2020 when rates hit their low of 0.47. Now we have a rising interest rate environment. Now we have a Fed that is raising rates, and things have changed.
So compare and contrast this, Brian, because we know that there are people that do buy and hold, right? So compare and contrast the buy and holders versus the people that are trying to time the market. I would think both of those scenarios are a little bit difficult. They're trying to do it on their own. You're not doing it on your own. You are doing things to kind of time the market with all these computer trend following models, but you're not really timing the market because nobody can really time the market. Buy and hold versus timing the market. How do you look at that?
Okay, good. Nobody can time the market. Trend following models adjust to the change in trends. We are reacting. We are not guessing, predicting, or timing. We are changing in our market strategy when the trend of the market changes. So that we have 5 different managers. 4 of the 5 are trend following. When the market trend for the NASDAQ is up, we follow that trend. When the market trend of the NASDAQ is down, we go to cash. When the market trend of gold and silver is trending higher, we are invested. When the market trend is going down, we're in cash. The 5th manager is more relative strength. He's able to look at over 1,800 different exchange traded funds, and he uses pure momentum, pure relative strength, where whatever is trending higher, he invests in. So for example, in 2000, 01, and 02, when the S&P was down 50% and markets and the NASDAQ was down 70%, there were sectors of the market, Mark, that were doing well. Real estate was doing well. Gold and silver were doing well. The energy markets were doing well. The healthcare markets, biotech, all were doing well in a market that got nailed 50% by the S&P, 70% by the NASDAQ. So his strategy is to buy whatever has positive relative strength and has the highest relative strength scores, and he's able to make money in these difficult markets. His program made money in 2008, and so we find these managers and we allocate money to them based on their several factors that we just keep internal.
We know that most people basically buy and hold, right? They've got a 401k at work and they just let it ride and hope for the best. How can those people, I mean, to me, they just call you 833-707-3030 and say, hey, what should we be doing? But don't most people just kind of sit there and just kind of let it do what it's going to do to them?
Yeah, most people are passive investors. They put their portfolio together. They get some advice on it, or they think about it, tweak it a little bit, but mostly buy and hold. And that has worked. That has worked well since March of 2009. As I said, there's been 4 times that the S&P has hit a point where it's traded flat for more than a decade. And so in that kind of environment, passive investing will send you back to work. How's that? Because when you pull money out of an account that hasn't made money in 10 years, for most people, unless you've got 7 or 8 figure net worth, for most people, that's terminal. They will have to go back to work to replenish their portfolio.
It's one of the opportunities that you have today, and you can take advantage of this right now, is just pick up the phone, call the team at Decker Retirement and say, holy cow, Brian, I've never thought of it the way you were talking about it. I would like to learn more. How does that affect me and my family and my portfolio? I like the idea, but I don't really know because I don't really understand it. Can you explain it to me? Well, that's what the team at Decker Retirement is all about. So they're not in the mode of trying to sell you things. It's what do you need to put yourself in a better position, whether it comes from the investment world, the insurance world. What tools do you need to put yourself in a better position? There are a lot of options out there. There's always new things in the insurance world and in the market, but we don't know that because we don't work in this world every day. Brian and the team at Decker Retirement do. So they've got ideas for you. The question is, are they? You don't know, right? You don't know all the options, but Brian and the team do. This is an opportunity, I think, for you to find out more about where you are and maybe making a tweak here or there. But how do you know what to do if you've never sat down with a team like Brian Decker's team of Decker Retirement Planning? Because it is about retirement planning. It's not the accumulation phase, guys. It's retirement, and it's a distribution phase. Different time of your life. Great opportunity again. 833-707-3030 is the number. 833-707-3030. Back with our final segment of Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning right after this.
We all want the freedom to do the things that make us happy, especially in retirement. To get help with laying the foundation for that freedom, call 833-707-2020 to have a chat with Brian. What if you ordered a pizza, but when you opened the box, a couple of pieces were missing? That would be upsetting, right? Now, think about how much you believe you've saved for retirement. Do you still owe taxes on that money? Brian Decker and his team at Decker Retirement Planning understand the importance of tax planning and can help you reduce the impact that Uncle Sam has on your retirement. Give them a call today to start working on your retirement tax plan at 833-707-3030. Now may be a great time to lower your future tax liability. Create a retirement plan today so that you can get as many slices of your retirement pie as possible. Give Brian Decker a call at 833-707-3030 and schedule a visit. That's 833-707-3030. Firm offers insurance services and may not give tax advice. Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. Again, you can go to the website to learn more, DeckerRetirementPlanning.com. Under the heading of Safer Retirement Education, you can download Brian's book on retirement, The Decker Approach, the three principles of retirement book, checklist, challenge, sample income plan. Those are just 4 of the 12 different things you can download. And it's there for your information, your knowledge, basically. There's no cost to this. There's no obligation. It's there for you to further your education, if you will, about retirement. Great opportunity. DeckerRetirementPlanning.com under the Safer Retirement Education. Get what you want. learn about what you want. It's certainly an opportunity for you. You can always call the team, 833-707-3030. It's 833-707-3030. And we've been talking about the Fed, and they raised the interest rate 7 times in 2022. They've done it twice so far in 2023, 0.5% in January, 0.25% in February. They're talking about another 0.25% bump in March. And so they're saying, though, that might be it. So if that's it, Brian, do you think the markets maybe because January was better, and if the Fed's going to slow down these interest rate bumps, doesn't the market like that?
Yeah, what the Fed's trying to orchestrate is a soft landing, meaning that we're able to pull this off without any recession or market crash. And that's really difficult to do. I think it's happened a couple of times, like 2 out of 9 or 10 times. It's definitely the minority. It's very difficult to do. So we'll see if they can pull it off. But I wanted, Mark, for the last topic here of the radio show, I want to talk about inflation, because if the Fed is trying to stop inflation, historically what happens is the CPI, the Consumer Price Index, which, by the way, Mark, is a joke because the government statistic doesn't include food and energy. Well, when you're retired, you don't eat any food or use any energy, do you?
I don't believe I do, no.
Okay. And we should probably just pull medical inflation too, because seniors don't use any of that either. The CPI, though, is a good indication of other types of inflation. And we do know that prices have gone up. So food prices and services, medical services, things like that. How do we help clients with inflation in their portfolio? Here's what we do. There's 5 different layers of protection that our clients at Decker Retirement Planning have built into their plan. Number 1, we put in a COLA, cost of living adjustment, into their plan. So when they retire at 65 or 62, whenever that is, there's a built-in COLA of 1.7% where we grow their income over time, and then we flatten it out in their 80s, because there's the go-go years, the slow-go years, and the no-go years. The go-go years, that's when you want your money. If we put in a 3 or 4 or 5% COLA, you're going to be getting very little in the beginning, and you're going to be getting a whole lot of money in your 80s and 90s when you're probably not going to be using it. So we flatten the COLA to push more money up to you during your healthy travel years. And clients like that. So that's number 1. That's 1 of 5. The COLA by itself doesn't fix inflation and be its one all inflation protection. It's 1 part of 5. The second part is the hard asset of owning a home. People that own a home or other real estate, like rental real estate, have an amazing hedge against inflation, because hard assets like real estate hold their value and go up in value when inflation goes higher. So in the late 70s, early 80s, real estate prices went up very quickly. If you had to, you could put a HELOC in, a home equity line of credit, and pull money out if needed in your retirement plan. We don't plan on it. It's not in the plan to do that, but it's a hedge for higher prices. We view the home as sacred. We typically don't put or recommend any reverse mortgages in place. We view your home as sacred and want to have you pass that on to your kids or grandkids. But the second part of the 5-part inflation hedge is real estate. The third part is any inheritances that you're going to get. It's a horrible topic to talk about, but Mark, life happens. Parents pass away. There's going to be an asset transfer. If it's significant, we look at that, we record it and take part of it as part of the income plan. That money, that injection of capital is coming into your plan. So we plan on it and try to be conservative in dollars and time. Number 4 is the risk bucket. The risk bucket, we plan on averaging about 6% when the managers have averaged over 3 times that. And so there's extra money that builds up in the risk bucket, and that money is a hedge against inflation. Clients can pull money from that account. They can take it. They can do family reunions. They can do a worldwide trip. They can buy a car. But there's extra typically in that account that is there for inflation protection. And fifth and final, Mark, when you're in your late 70s, early 80s, your back hurts, your hips hurt, your knees hurt, your elbows hurt. I think your eyebrow hair hurts when you're in your late 70s, early 80s, and it's no longer fun to garden, take care of the property, go up and down the stairs. And so your friends call you, hey, Mark, come on down with us. We've got this community. You know all these people anyhow. They're all your friends. Come down. We got medical services right here. Sell your house for X, buy a condo for Y. And there's an injection of capital of a lot of money, high six figures, lower seven figures into the plan. And that helps our clients get another kickstart of money. And the people that do this, yes, they have inflation exposure. We all do. But their inflation risk is really small when we build all 5 layers of protection, of inflation protection, into the plan. It's not a plan of hope prices go down. We plan on prices going up. That's why we have the COLA. That's why we have future injections of capital into place. If you don't have a robust inflation plan like we talked about, Mark, this is another key reason why people call us and want to come in and do the planning.
Hey, and here's the deal. This is a great opportunity for you, as Brian said, to find out more and how the team at Decker Retirement can help. It's 833-707-3030, 833-707-3030. Again, there's no cost for this. There's no pressure. There's no obligation. There's no judgment either, right? The team's here to help you moving forward. 833-707-3030. You know what I'd like to do before we run out of time on today's show, Brian, is what happens when somebody does call 833-707-3030. You went through the whole meeting process, and it's like 6 different meetings, and different topics are covered all the time through it. It's income, investments, taxes, healthcare, legacy planning, Social Security's in the income part, Medicare's in the healthcare part. That's a lot of moving pieces. What happens, though, when somebody calls this show and says, hey, I would like to chat with the team, 833-707-3030? What happens?
Depending on where they live, a planner is assigned and an appointment is set, and we have a get-to-know-you meeting and find out what your goals are, where you are in life. Are you retired, or are you still got a few years to go? And it's just an assessment, and we find out as far as strategies that you have in place. And we have a plan where if it ain't broke, don't fix it. We use what's working, we keep what's working, but we recommend changes to what's going to hurt you. We take our fiduciary responsibility very seriously. And Mark, probably one of the biggest things is we employ tax minimization strategies, where clients, when they hear our strategies, some of them get ticked at their CPA for not bringing it up. But we employ tax minimization strategies that help people with rental real estate create tax-free income stream, people with large capital gains, how they can avoid paying those capital gains, people with large amount of corporate stock in their 401k, how we can use tax strategies to pull those funds out and pay capital gains on just a portion of those funds. Anyhow, there's several strategies, Mark, that we use that are able to bring the taxes owed way down for our clients.
So again, it's 833-707-3030, 833-707-3030 to chat with the team. They are here to help, but it is about you. It's about your hopes and dreams, your bucket list things that you want to accomplish. How do we do that? Well, you got to break down all those different parts. The pillars are the same: income, investment, taxes, healthcare, legacy planning. Everybody that comes in, those are the pillars. But what goes inside of them is different depending upon whom they're sitting down with, because every plan, the Safer Retirement process, focuses on income planning and distribution planning. It is about whomever they're sitting down with: single, divorced, widow, widower, married couple. It's all about whomever they're sitting down with, and the plan is based on you and your situation. Again, it's 833-707-3030. So winter is still here. How are the knees holding up on the ski slopes? You got new knees. How are they doing?
Oh, Mark, anyone out there listening that had a knee replacement, they know what I've been through. In the last 9 months, I was in a lot of pain and was limping around. I went skiing day one, and it jostled my knee, so it ripped out all the scar tissue. And I didn't fall that day, but the skiing, the bumps, just the movement really helped my knees. So I've not had any problems since 1st of December, when my wife dragged me up on the ski slopes and told me to get my rear end up there.
If you've had a knee replacement, get up on the ski slopes and let it knock everything back into place.
If it's more than 6 months, yes.
Yeah, not that next week, right?
Yeah.
There's got to be a little time there. Well, I'm glad you're doing well and your knee is good and the slopes have fixed it because you love to ski. And I know a lot of our listeners do as well. So stay safe out there. There's no question about it. Look out for yourself and have good health. But at the end of the day, that's really about health and about income. How do we plan for retirement? Brian and the team at Decker Retirement are here to help you. And it's about you and your situation. 833-707-3030 again is the number. 833-707-3030. Brian, appreciate your time as always. Enjoy the rest of the weekend, Brian. Have a great week. We'll do it again next week.
Sounds good, Mark. Thank you.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.